Silver just did something it hasn't done in over 40 years. And what happened next shocked even the most experienced precious metals analysts. Right now, as you're watching this video, there's a massive disconnect happening in the global silver market. In some parts of the world, people are paying $87 per ounce for physical silver, while the official price shows something completely different. Major banks are scrambling. Physical vaults are being drained at unprecedented rates. And China just did something that signals we're entering a completely new era for precious metals. By the end of this video, you'll understand exactly what's happening, why it matters, and what could happen next. But first, let me show you something that most people are completely missing. Welcome to Bullion Logics, your source for deep analysis on precious metals markets. I'm here to help you understand what's really happening with gold and silver beyond the headlines and mainstream narratives. If this is your first time here, welcome. We dive deep into market fundamentals, geopolitical factors, and real-world data to help you make informed decisions. Go ahead and hit that subscribe button right now and turn on notifications so you never miss critical updates. And if you're a returning viewer, thank you for being part of this community. Your support through likes, comments, and shares is what allows us to keep bringing you this analysis. So please take a second to hit that thumbs up button. It makes a huge difference. Today, we're covering something absolutely historic. The precious metals market is undergoing a transformation that could reshape wealth preservation for decades to come. We're going to examine current price movements, supply and demand dynamics, what's happening in China and India, technical analysis, and most importantly, what this all means for your financial future. This is going to be comprehensive, so get comfortable. Let's dive in. Let's start with a current state of the market, because the numbers we're seeing right now are absolutely remarkable. Gold futures are trading around $4,400 per ounce, with recent gains of approximately $20 in single trading sessions. This represents a continuation of a powerful uptrend that has pushed gold to levels most people thought were years away. But here's where it gets really interesting. Silver is not just following gold, it's outperforming it on a percentage basis. In March, silver futures have climbed into the $78 to $80 range, with some sessions showing gains of several dollars per ounce. Now, why does this matter? Because historically, when silver begins outperforming gold on a percentage basis, it signals that we're entering a more aggressive phase of a precious metals bull market. Silver tends to lag in the early stages, and then explosively catch up as the trend matures. The gold to silver ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. This ratio has been compressing from levels above 80 down to around 60. Every point of compression represents silver gaining relative to gold. Here's what many analysts are missing. We're not just seeing price increases, we're witnessing a fundamental shift in how the market values these metals. The old paradigms are breaking down, new dynamics are taking over. When you look at where we are right now versus where we were just 5 years ago, the transformation is stunning. Silver was trading at $11 per ounce in 2020 during the market crash. Think about that. From $11 to $80 in roughly 5 years. That's more than a 7-fold increase. Gold has had an impressive run as well, but silver's move has been even more dramatic. And there are very specific reasons why this is happening, which we're going to explore in detail. There's an old saying in financial markets that bond traders are the smartest people in the room. They understand complex relationships between interest rates, inflation, credit risk, and currency values. But right now, I'm going to make a bold statement. Precious metals traders are demonstrating the most sophisticated forward thinking in the entire financial world. Why? Precious metals investors are looking over the horizon at what's coming. They're not reacting to today's news. They're positioning for tomorrow's reality. Look at what's happening globally. We're seeing major geopolitical shifts that could reshape the international order. In the Western Hemisphere, there are discussions about expanding spheres of influence and controlling strategic resources. In Europe, defense alliances that have been stable for decades are being questioned. In Asia, territorial disputes and power competition continue to escalate. In the Middle East, conflicts that were thought to be winding down are creating new instabilities. Each of these situations creates uncertainty, and uncertainty drives demand for assets that maintain value regardless of which government is in power or which currency is dominant. Here's the key insight. These are not temporary situations that will be resolved in weeks or months. These are structural shifts that could define geopolitics for the next decade or longer. Smart investors understand this, and they're not waiting for mainstream financial media to tell them what to do. They're buying gold and silver now, while most people are still focused on short-term market movements and quarterly earnings reports. The safe haven bid we're seeing in precious metals isn't panic buying. It is strategic allocation by sophisticated investors who understand that geopolitical risk premiums are underpriced in most asset classes, but properly reflected in gold and silver. This creates a situation where any significant pullback in precious metals prices is likely to be met with strong buying. The buying interest provides a floor under the market and supports the continuation of the uptrend. Now let's talk about the foundation of any market, supply and demand, because what's happening here is absolutely critical to understanding where prices are headed. Starting with supply, global mining production of silver has been essentially flat for years. In some cases, it's actually declined slightly. This isn't because mining companies don't want to produce more silver. It's because finding and developing new silver mines is incredibly difficult and time-consuming. From the moment a deposit is discovered until the day a mine starts producing metal, you're looking at 5 to 10 years minimum. You need exploration, feasibility studies, environmental permits, financing, construction, and commissioning. Each step takes time and costs money. What this means is that even though silver prices are much higher now than they were a few years ago, we won't see a flood of new supply entering the market anytime soon. The pipeline of new projects is limited, and existing mines face rising costs. Energy costs have increased substantially. Labor costs are up. Equipment and supplies are more expensive, and many older mines are dealing with declining ore grades, which means they have to process more rock to extract the same amount of silver. Now, let's look at demand, because this is where things get really interesting. We're seeing demand growth from multiple sources simultaneously. First, industrial demand for silver continues to expand. Silver is essential for solar panel production, and as countries worldwide push toward renewable energy goals, this demand is growing rapidly. Some projections suggest solar demand for silver could double within 5 years. Second, the electronics industry consumes massive amounts of silver. Every smartphone, every computer, every server, and every data center contains silver. And with the build-out of artificial intelligence infrastructure and 5G networks, this demand is accelerating. Third, electric vehicles contain significantly more silver than traditional vehicles. As EV adoption increases globally, this represents another expanding demand source. Fourth, jewelry demand is growing as consumers look for beautiful, valuable alternatives to increasingly expensive gold jewelry. Silver offers similar aesthetic appeal at a more accessible price point. Fifth, investment demand through coins and bars remains strong. Individual investors worldwide continue to accumulate physical silver as a hedge against currency debasement and economic uncertainty. But here's the category that almost nobody is talking about yet: tokenization. Major cryptocurrency companies have already created digital tokens backed by physical gold stored in vaults. They've become some of the world's largest gold buyers through this mechanism. The same model can be applied to silver, potentially creating an entirely new category of demand. When you add up all these demand sources and compare them to flat or declining supply, you get what's called a structural deficit. The world is consuming more silver than it's producing. That deficit is being filled by drawing down above-ground inventories, but those inventories aren't infinite. At some point, the inventories will be depleted to levels where the market becomes extremely tight. When that happens, prices will have to rise to a level that either incentivizes new supply or destroys some demand. Given the time required to bring new supply online, the initial response will have to come through price increases. This is the fundamental setup that supports much higher silver prices in the coming years. Now, we need to talk about what might be the single most important dynamic in today's silver market: what's happening in China. Recent data coming out of China is absolutely remarkable. The Shanghai Gold Exchange spot price for silver has been trading at substantial premiums to Western prices. We're talking about premiums of $10, $15, even $20 per ounce above the prices quoted in New York or London. Let me be clear about what this means. When physical buyers in China are willing to pay $87 per ounce while the New York spot price shows $76, it tells us something crucial. The Western paper price doesn't reflect the true supply-demand balance for physical metal. The futures exchanges trade enormous volumes of paper contracts, but when you actually want to take delivery of physical silver, you discover that the real price is much higher than the paper price suggests. We're also seeing dramatic declines in silver inventories at Chinese exchanges. In recent weeks, tens of thousands of kilograms have been withdrawn from Shanghai vaults. This represents a significant percentage of total available inventory, and it's happening at an accelerating pace. Why is China accumulating so much silver? There are several reasons. Industrial consumption is growing as China's manufacturing sector continues to expand. China is the world's largest producer of solar panels, electronics, and increasingly electric vehicles. All of these products require silver. Investment demand is strong as Chinese citizens look for alternatives to a struggling real estate market and volatile stock market. Physical precious metals offer tangible value that can't be erased by policy changes or market crashes. There's also likely strategic accumulation happening at state or institutional levels. China understands that silver is critical for future technologies and may be positioning to ensure adequate supply. Here's something really important. China's silver market is experiencing backwardation. Backwardation occurs when the spot price exceeds the futures price. This is the opposite of the normal market structure. In a normal market, Futures prices are higher than spot prices because you're paying for the convenience of deferred delivery. But in backwardation, people are so desperate for immediate physical delivery that they'll pay more for spot than for futures. Backwardation is a sign of extreme tightness in physical supply. It indicates that the market structure is under stress and that physical demand is overwhelming available supply. Historically, backwardation in precious metals has preceded significant price advances. It's a signal that the paper market is losing control and the physical market is asserting itself. The Chinese market is essentially setting a floor under silver prices. Even if Western futures traders try to push prices lower by selling paper contracts, physical demand from China will absorb any available supply at those lower prices and prevent significant declines. This creates an asymmetric situation, limited downside due to strong physical demand, but potentially unlimited upside as the supply shortage becomes more apparent. While everyone focuses on China, we can't overlook India's enormous and growing impact on precious metals markets. India has a population approaching 1.5 billion people. More importantly, hundreds of millions of Indians are entering the middle class for the first time in their family histories. As incomes rise, cultural traditions around gold and silver mean that demand is set to explode. Indian culture has a relationship with precious metals that goes back thousands of years. Gold and silver aren't just investments. They're integral to weddings, festivals, religious ceremonies, and family traditions. They represent stored wealth that passes through generations. As India's economy grows at a rapid pace, more families have discretionary income to allocate toward precious metals. This isn't speculative buying that will reverse at the first sign of trouble. This is cultural accumulation for long-term holding. Import data shows India bringing in massive quantities of silver. These imports aren't for industrial use or short-term trading. They're going into Indian households as jewelry, coins, and bars that will likely never be sold. Unlike Western investors who might sell during price spikes to lock in profits, Indian buyers typically hold their precious metals for life and pass them to their children. This metal is effectively removed from available supply. The combination of Chinese and Indian demand represents something unprecedented in precious metals markets. Together, these two countries account for nearly 40% of the world's population. As their economies continue to grow and their citizens accumulate metal, the impact on global supply and demand will be profound. This isn't a trend that will reverse next quarter or next year. This is a multi-decade shift in global wealth patterns, and precious metals are right at the center of it. Let's examine the technical picture for silver, because the charts are telling a very interesting story. Silver recently accomplished something it hadn't done in over 40 years. It decisively broke through the $50 level. This wasn't just a brief spike that immediately reversed. Silver pushed through 50, reached levels above $80, and then when it pulled back, it held support above $70. This is textbook technical action for a major breakout. When a long-term resistance level is broken, it often becomes support. The fact that silver is held above the 70 to 7150 area after breaking through it suggests that level is now the floor. Using Fibonacci analysis, a mathematical tool based on ratios that appear frequently in nature and markets, we can identify potential targets for this move. Taking the previous cycle from 1980 to 2011 and projecting forward using Fibonacci extensions, we get targets around 7150, which we've already reached and held, then higher levels around $121, and eventually around $140. Interestingly, there's another mathematical sequence called the Lucas sequence that also appears in market behavior. The Lucas numbers include 11, 18, 29, 47, 76, 123, and 199. Look at silver's behavior over the past 5 years. It bottomed around $11 in 2020. It hit resistance around $29. It found support around $18. It broke through $47. And right now it's trading around $76. The next Lucas number is 123. This is not mysticism. These are mathematical relationships that markets often respect because they reflect patterns in human psychology and behavior. What's particularly important about the current technical setup is that silver is making new all-time highs. When any asset enters new all-time high territory, it means there are no prior buyers sitting at higher prices waiting to break even and sell. Everyone who owns silver right now is profitable. This removes a major source of selling pressure called overhead resistance. Without people trying to get back to break even, the path of least resistance is often higher. Of course, markets don't move in straight lines. We will see pullbacks. We will see consolidation periods. The question is whether those pullbacks break major support levels or whether they're just healthy corrections within an ongoing uptrend. As long as silver holds above the 70 to 7150 area, the technical picture remains bullish and suggests continuation toward higher targets. A break below that level would be concerning and might signal a deeper correction. For gold, similar analysis suggests room for significant additional upside. with near-term potential toward $4,600 to $4,800 and possibly much higher over longer time frames. One of the most critical concepts for anyone interested in precious metals to understand is the difference between paper markets and physical markets. Paper markets include futures contracts, ETFs, and other financial instruments that provide price exposure without necessarily involving actual metal. Physical markets involve buying and selling actual coins, bars, and bullion. Recent data shows absolutely staggering volumes in paper-silver trading. On certain days, the equivalent of 760 million ounces trades on futures exchanges. To put that in perspective, total global mine production for an entire year is less than 1 billion ounces. Think about what that means. In a single day, paper trading volume approaches an entire year's worth of mining production. This isn't normal commercial activity. This is price management. Large institutions can sell massive quantities of paper contracts to push prices down, even when physical demand is strong and supply is tight. This has been used for years to keep precious metals prices suppressed relative to where fundamentals would suggest they should be. However, something fundamental is changing. The physical market is beginning to override the paper market's price signals. We see this most clearly in the premiums being paid for physical metal over futures prices, especially in Asian markets. When buyers in China must pay $10 to $20 per ounce over the futures price to obtain actual metal, it's clear that the futures price is artificial. The futures price represents what paper contracts trade for. The premium represents what physical metal actually costs. As this gap widens, it signals that the paper pricing mechanism is breaking down. There are also serious questions about whether the entities selling paper contracts actually have sufficient physical metal to deliver if contract holders demand it. If the same physical metal has been sold multiple times to different buyers, a practice that has been alleged in precious metals markets, then a crisis could occur if too many buyers simultaneously demand delivery. This is why sophisticated investors often prefer to hold physical metal directly rather than paper claims. Physical possession eliminates counterparty risk. You can't have a claim against something that doesn't exist if you physically hold it yourself. As the disconnect between paper and physical prices grows, one of two things must happen. Either physical prices must fall to meet paper prices, which seems unlikely given strong global demand, or paper prices must rise to meet physical prices. Based on current trends, it appears increasingly likely that paper prices will be forced higher to reflect physical market reality. It's noteworthy when major financial institutions begin acknowledging the potential for higher precious metals prices, because these organizations have traditionally been skeptical of gold and silver. Recent analysis from one of the world's largest banks included projections for silver potentially reaching $35 to $39 per ounce. Now, you might look at current prices around $80 and think those targets seem low. But remember, large banks are often conservative in their public projections, and their published targets may lag their internal expectations. The fact that they're discussing $35 to $39 represents acknowledgement of upward momentum. It also provides validation for precious metals investors who have been accumulating at lower prices over the years. When the mainstream financial establishment begins acknowledging what you've believed all along, it often signals that you're early to a major trend. When institutional money begins flowing into precious metals at scale, it creates powerful moves because these entities deploy enormous amounts of capital. A single pension fund or sovereign wealth fund allocating just 1 to 2% of their portfolio to precious metals represents billions of dollars of buying power. We're also seeing increasing interest from family offices, the investment vehicles of ultra-wealthy families. These sophisticated investors are diversifying away from traditional financial assets and into tangible stores of value. This institutional interest is still in relatively early stages. As it grows, it will provide sustained buying pressure that supports higher prices. Now let's address the fundamental driver behind precious metals appreciation. What's happening with fiat currencies? The Federal Reserve and other central banks operate on a system of creating currency through credit expansion. This isn't controversial. They acknowledge it openly. Money is created through lending, and the money supply has expanded exponentially over recent decades. Consider this comparison. In the 1970s, a nice home might cost $30,000 to $50,000. A good car cost $3,000 to $4,000. If you were a millionaire in the 70s, you were at the top of the economic pyramid. Today, those same homes cost $300,000 to $500,000 or more. Cars cost $30,000 to $40,000. Being a millionaire is nice, but it's far from the top of the wealth spectrum. What changed? The houses and cars didn't fundamentally change. What changed was the currency. The purchasing power of the dollar has been systematically eroded through expansion of the money supply. This is the essence of currency debasement. When the supply of money grows faster than the supply of goods and services, each unit of currency loses value. Prices appear to rise, but really the currency is falling. The total debt of the world's top 25 nations exceeds $100 trillion. This debt will never be repaid through taxation. It's mathematically impossible. The only way to reduce the real burden of this debt is through inflation, which erodes its value but also destroys the purchasing power of everyone's savings. Throughout history, during periods of currency debasement and monetary instability, gold and silver have preserved wealth. They can't be created at will by central banks. Their supply is limited by geology and the physical difficulty of mining them. We're entering a period where trust in fiat currencies and the institutions managing them is declining globally. When confidence in monetary systems weakens, people naturally seek alternative stores of value. This isn't about predicting the collapse of civilization. It's about recognizing that currencies lose purchasing power over time through deliberate policy, and protecting yourself requires holding assets that maintain value despite the debasement. Gold and silver have performed this function for thousands of years. There's no reason to think that will change now. One of the most reliable indicators of genuine demand is what we observe at the retail level, and the signals right now are remarkable. Reports from precious metals dealers worldwide paint a consistent picture. Demand is strong, and in many cases overwhelming their ability to supply. Images from Australia show long lines of customers waiting hours outside bullion dealers to purchase precious metals. These aren't people lining up for a sale on consumer electronics. These are individuals patiently waiting to convert fiat currency into tangible assets. Dealers in China report that they cannot source inventory at official prices. They must pay substantial premiums to obtain physical metal, which they then pass along to customers. Yet, despite paying higher prices, buying continues because people understand the fundamental value proposition. Western dealers report delays in fulfilling orders, particularly for silver products. Mints are running at full capacity, yet cannot keep up with demand. Premiums over spot prices have risen as dealers struggle to maintain inventory. This retail demand is significant because it represents conviction from everyday investors. These aren't hedge funds making tactical trades that could reverse on any given day. These are individuals making strategic decisions about wealth preservation for themselves and their families. When retail demand reaches these levels, it creates a solid foundation under the market. These buyers typically have longer time horizons and aren't easily shaken out by short-term price movements. The mining sector provides crucial context for understanding future supply constraints. Mining companies face rising costs across every aspect of their operations. Energy costs have increased substantially. Labor costs are up. Equipment and supplies are more expensive. Regulatory compliance adds costs. And many mines are dealing with declining ore grades, meaning they must process more rock to produce the same amount of metal. These rising costs mean that mines that were profitable at lower metal prices might struggle at those same prices today. Some marginal operations have closed, removing supply from the market. Developing new mines is extraordinarily difficult. It requires massive capital investment, often billions of dollars. It requires navigating complex regulatory approval processes that can take years. It requires building infrastructure in often remote locations, and it requires access to skilled labor and specialized equipment. The result is that even with higher metal prices incentivizing new production, supply cannot respond quickly. We're likely looking at a situation where supply remains constrained for years, providing fundamental support for higher prices. Mining company stocks theoretically should benefit from higher metal prices through expanded profit margins. However, mining stocks have significantly lagged the metals themselves, creating what some investors view as an opportunity. As the bull market in precious metals matures, investors often increasingly look to mining stocks as leverage plays on rising metal prices. A 10% increase in the metal price might translate to a 30 or 40% increase in mining company profits, which should eventually be reflected in stock prices. Looking forward, several emerging technologies could create entirely new categories of silver demand. Tokenization of physical assets is gaining real traction. The concept is straightforward. Physical silver stored in secure vaults can be represented by digital tokens on a blockchain. These tokens can be easily bought, sold, and transferred while the physical metal remains safely in storage. Major cryptocurrency companies have already implemented this model successfully with gold, becoming some of the largest buyers of physical gold globally in the process. The same model can be applied to silver, potentially creating enormous new demand from digital native investors. The expansion of renewable energy infrastructure represents another massive growth driver. Solar installations are accelerating worldwide as countries pursue carbon reduction goals. Each installation requires silver, and this demand could grow exponentially over the next decade. Electric vehicle adoption creates another expanding demand source. EVs contain significantly more silver than traditional internal combustion vehicles due to their electrical systems, motors, and battery management systems. As EV penetration increases globally, so will silver consumption. The build-out of 5G networks and future 6G technology will require massive amounts of silver and infrastructure equipment. Every cell tower, every connection point, every device contains silver components that enable the high-speed connectivity we increasingly depend on. These emerging demand sources are in addition to existing industrial, jewelry, and investment demand. They represent new categories that didn't exist a decade ago, and they're all growing. While the fundamental case for precious metals is compelling, we must honestly address risks and considerations. Price volatility is guaranteed. Precious metals experience sharp pullbacks that test the conviction of holders. Anyone allocating capital to this sector must be psychologically prepared for significant price swings and must avoid over-leveraging or investing money they cannot afford to have tied up. Regulatory risk exists. Governments have historically taken actions to restrict private precious metals ownership during extreme monetary crises. While such actions seem less likely in modern times, they can't be completely ruled out. Market manipulation is a legitimate concern. Large institutions with access to enormous capital can potentially influence prices in the short term, even if they can't change long-term fundamentals. This can be frustrating for investors who are directionally correct but wrong on timing. Physical metal requires proper storage and security. Unlike stocks in a brokerage account, physical gold and silver must be stored safely. This involves costs and considerations around home storage, safe deposit boxes, or professional vault services. Liquidity varies depending on what form of precious metals you own. Common government mint coins and standard bars can generally be sold quickly at fair prices. Unusual or numismatic items may take longer to find buyers. These risks don't invalidate the case for precious metals, but they need to be understood and factored into decision-making. For those considering precious metals as part of their overall financial strategy, several factors deserve careful thought. Allocation decisions are deeply personal and depend on individual circumstances, risk tolerance, and objectives. Some financial advisors suggest 5 to 10% of a portfolio in precious metals as a hedge. More aggressive precious metals advocates might suggest 20 to 30% or higher. There's no universally correct answer. The form of ownership matters significantly. Physical metal provides direct ownership but requires storage solutions. ETFs offer convenience and liquidity, but introduce counterparty risk. Mining stocks provide leverage to metal prices, but involve company-specific risks. Futures and options offer maximum leverage, but are complex instruments unsuitable for inexperienced investors. Time horizon is absolutely crucial. Precious metals should generally be viewed as long-term holdings, not short-term trades. Anyone who might need their capital back in the near term should be cautious about heavy allocation to precious metals. Dollar cost averaging. Investing fixed amounts on a regular schedule can help smooth out volatility and remove emotion from the investment process. This approach means you automatically buy more when prices are lower and less when prices are higher. Most importantly, any investment decisions should be made based on your own research, understanding, and circumstances, never based on fear, greed, or what someone else is doing. We've covered an enormous amount of ground in this analysis, examining precious metals markets from multiple angles and perspectives. Let me summarize the key themes. Gold and silver are experiencing significant appreciation driven by converging factors. Geopolitical uncertainty is creating sustained safe haven demand. Supply and demand fundamentals strongly favor higher prices, with supply constrained and demand expanding across multiple categories. The gap between paper market prices and physical market prices is widening, suggesting paper prices must eventually rise. China and India are absorbing massive quantities of physical metal that likely won't return to the market. Technical analysis suggests substantial room for additional upside. Currency debasement continues, systematically eroding fiat purchasing power. Both retail and institutional interest is growing. What does all this mean for you? If you're already holding precious metals, the evidence supports maintaining your position with a long-term perspective. Don't let short-term volatility shake you out of a fundamentally sound position. If you're considering an initial allocation, do thorough research, understand the risks, and make decisions appropriate for your specific situation. Don't invest emotionally or based on fear. Make rational decisions, grounded in facts and analysis. Most importantly, stay informed. The precious metals story continues to evolve, and new developments occur regularly that affect the outlook. Before you go, please take a moment to support this channel if you found this analysis valuable. Subscribe to Bullion Logics if you haven't already. We are building a community of informed precious metals investors, and your participation matters. Hit the notification bell so you're alerted when we publish new content. Give this video a thumbs up. It genuinely helps with the algorithm and allows us to reach more people who need this information. Leave a comment sharing your perspective on where gold and silver are headed. I read every comment and love the discussion and diverse viewpoints from this community. Share this video with anyone you think would benefit from understanding these market dynamics. The more people who understand what's happening, the better prepared we'll all be. Remember, we're all navigating these complex markets together, trying to make the best decisions possible with the information available to us. Stay curious, stay informed, stay rational, and stay prepared for whatever comes next. Thank you so much for investing your time with Boolean Logics today. I'll see you in the next analysis. Until then, stay sharp and stack smart.